Yep, one more. All right, well, welcome everybody. Thank you so much for joining us today for this call. It is Tuesday, March 14th, and the purpose of this call was really in response to all of the drama since Thursday of last week with the collapse of Silicon Valley Bank. The kind of my agenda for the call today is first just give you a basic overview of what the events were that triggered this call today. Dru's going to be catching us up on that. Then we'll move into a conversation about, what are we looking at right now? What am I worried about right now? And how does it relate to you guys and your portfolios? So we'll talk a little bit about specifically about TD and Schwab. We'll talk about the effect of the volatility in stocks on your portfolios. And then finally, we're going to end with what are we going to be continuing to look at as these next couple weeks develop, specifically the Fed meeting in a week and the effect on ongoing interest rates and inflation. So that's kind of my agenda for today. There will be time for questions at the end of the meeting also, but we're going to go ahead and start it off with Dru catching us up on what were the events over the past past week or so that necessitated this call today. So, all right, Dru, you're in the spotlight. Take it away. All right, unmute yourself.
Oh, sorry about that. Hi, everybody. Things are changing day by day, hour by hour, even as the SEC and Justice Department just a couple hours ago said they'll begin investigating what exactly happened at Silicon Valley Bank. But what we do know is SVB's deposits grew from about $60 billion at the end of 2019 to tripled to $180 billion by the end of 2021 as the startup customers they had raised a ton of money from venture capitalist groups. SVB with those deposits couldn't lend it out quickly enough, so they began looking for something else to do with that money. Unfortunately, it looks like a large part of those monies went into long-dated mortgage-backed securities, where SVB put over half of its assets into fixed-rate securities, which is higher than the ratio of most large commercial banks. So whether it was deliberate or not, SVB was betting heavily on interest rates not rising. So as interest rates rose, 1-year treasuries went from yielding about 0.05%, basically nothing, to more than 5% over this last year. So as that happened, the value of those mortgage-backed securities tanked. As that's happening, people were worried about the liquidity at SVB. So some venture capitalist groups seem to have started withdrawing their money, which kind of created a run at the bank. Account holders were already beginning to withdraw a lot more money in 2022 as the funding incoming into those startups kind of slowed down. So to provide this liquidity, the bank had to sell already depressed assets, at fire sale prices. So, John will go into the other details. There was FDIC limits that, seem to have been an issue of a lot of their customers having a lot of over insured amounts in their accounts. So, that's changing. John will have a little bit more information on, what's next regarding FDIC limits in your accounts.
Awesome. Thank you, Dru. Okay. Okay. All right. So kind of what's happening right now. So in the aftermath of the collapse of Silicon Valley Bank, we saw huge volatility in a lot of kind of mid-level, mid-sized bank stocks. Now we say mid-sized bank stocks. These banks are still huge, okay? They're just not one of the top four that we typically think of, right? They're not B of A, they're not Wells Fargo, they're not Citigroup, okay? That being said, Silicon Valley Bank was, I think it was the 14th largest bank in the country still. So huge bank, right? So other banks kind of in that similar size had some huge volatility issues in their stock prices, okay? First Republic was one of them, but most alarming, Schwab was one of them, okay? And I really want to get into that because your accounts, all of your accounts are held at either TD Ameritrade or Schwab, but Schwab bought TD Ameritrade, okay? So all of you guys have exposure to Schwab, all right? Now there's a really important point here that I want to make extremely clear. Your investments are not subject to the solvency of Schwab/TD, okay? Whenever you have an investment portfolio, those investments are segregated assets. They don't belong to the bank. If the bank goes bankrupt, those investments are still there, okay? So it does not matter if Schwab or TD go bankrupt from the standpoint of the protection of your investment portfolios, okay? So I want to like hammer that point home like crazy. You do not need to be concerned about the solvency of the company for the protection of your money. Okay. Now, that being said, we still don't want TD or Schwab to go under. Okay. And we don't want some type of panic contagion that's launched by the collapse of Silicon Valley Bank and Signature Bank to affect them. So that's one of the things we're watching really closely. All right. I watched the interview with the Schwab CEO this morning when he was talking about the effect of why his stock was being disrupted and going up and down and all that stuff. Okay. And he made a lot of excuses, right? But really the key point is, banks like Schwab, okay, they don't loan out most of their deposits. Okay, most of their deposits end up getting invested. Okay, of all the money that Schwab has on deposit in its bank side, okay, only 20% of it is loaned out. Okay, through people borrowing money from Schwab. The rest of it they invested. Okay, and they invested in government-backed securities. All right. Now, just like Silicon Valley Bank, the value of those bonds have dropped as interest rates have gone up, okay? And because Schwab does not loan out most of the money it has on deposit, it's more subject than other banks to that volatility in the bonds, okay? So on paper, when you have to mark the price of those bonds to market, they've seen a big drop in their reserves. Okay. Now they've said that it's not enough of a drop to be concerned about. They've said that they have plenty of access to liquidity through lines of credit. And, the government has come out and created this new lending program where they'll lend billions and billions of dollars in addition to any lending facilities that these banks already have in place. So at this moment in time, you should not be concerned, and I am not concerned about the solvency of TD Ameritrade and Schwab, but you better believe that's on the top of my list of the things that I'm looking out for, okay? Now, if Schwab were to become insolvent, right, to go under, okay, the only part of your portfolio that is subject to the solvency of Schwab is the part that is in the Schwab or TD money market investment. Okay, that's kind of like having a bank account at Schwab Bank or TD Bank. Okay. It is a liability. That money market investment that you own is a liability of the bank. Now, almost all of you have our FDIC insured money market investment as part of your portfolio. And it just holds that tiny amount of cash that we keep in your portfolio as we do trades in and out and as we send money to you. Okay. And with the exception of 2 clients, and you know who you are because we've already reached out to you, you are all within the FDIC insured limits, okay, for that money market. So even if Schwab went bankrupt, okay, and thus TD Ameritrade went bankrupt, number 1 protection, all of your portfolio is segregated assets. It's still there no matter what. Number 2 protection, the part that you have in the money market is FDIC insured and within the FDIC insurance limits, okay? Now, those of you who have the non-FDIC insured money market, if you have any concerns about that and you want to make a change, that would be a follow-up to our meeting today, okay? I am not concerned enough to be recommending that to anybody, but if you're concerned, frankly, it's not going to make or break your financial situation, whether you're earning 4% in a non-FDIC insured money market or 1% in an FDIC insured. So I'm happy to make the change for you. Okay. So that would be a follow-up to this call today. All right. Portfolios. Okay. The volatility in the financial stocks have had really no material impact on your portfolio performance. All right. The financial sector, the US financial sector makes up less than 5% of most of your portfolios. And so and the entire sector hasn't even had a uniform bad performance as of last Thursday. So I'm as of today, I'm not concerned about what's been going on. It's on the impact of your long-term portfolio performance, even on the short-term portfolio performance. You know, most of you guys are still up about 10% from what was the bottom of this bear market at the end of September of last year. Okay, even with the pullback we had in February, okay, most of you guys are still up about 10% from the bottom. Okay, I think it is more likely than not that we continue growing from here. That does not mean that's a given. Okay, and there's plenty of things that could derail it, including this banking crisis becoming a true crisis. Okay, but the biggest thing would be reaction from the Fed. Okay, so let's talk about the Fed. All right, so what are we watching for going forward? All right, the Fed meets in 1 week. Okay, they're going to meet on March 21st and March 22nd, and then we'll get the decision on the next Fed rate hike after that meeting. All right, now previous to Silicon Valley Bank's collapse last Thursday, the market was betting on a 0.5% increase. Okay, so kind of a continue of the trend that the Fed's been on. Now, post the collapse of Silicon Valley Bank, the market is betting on a 0.25% increase. So they're betting the Fed's going to slow down a little bit. I would really, really, really prefer to see a complete pause from the Fed. I think continued increases are unnecessary at this point. I think what the collapse of Silicon Valley Bank has demonstrated is that there is a much longer term delay in the impact of interest rate increases than we've really appreciated. I think the market tends to be extremely impatient and expects that, hey, as soon as these rates, as soon as rates go up, they're immediately integrated into the whole financial system, and we know the impact right away. And that's just simply not true. It takes much, much longer for the effect of an interest rate increase to work its way through the economic system and for us really to understand the consequences of it. And I think I think it continues to be a little bit irresponsible to be increasing interest rates so quickly really in light of the collapse of Silicon Valley Bank. So I'm really hoping the Fed agrees with me and takes a pause next week. The market's betting that they do increase it 0.25%. Honestly, from the standpoint of your portfolios, I'm okay with a 0.25% increase or a complete pause. I think a 0.5% increase would send the market low and make it more likely that the Fed's actions push us into a recession, which would be a double dip type of scenario. Okay, it's not like a 100% cause and effect that if the Fed increases 0.5%, we have a double dip and the market touches new lows, right? And your portfolios drop 10% from where they are today. That's not a given, but it certainly increases the potential of that outcome if they do end up increasing it 0.5%. But I don't think that's what's going to happen. So watching the Fed continues to be the number one thing we're looking out for when it comes to your portfolio management. And then in light of the collapse of SVB, continuing to monitor Schwab and making sure that it is as solvent as they say they are, and that there are not going to be any problems, and that if there are problems, I want to make sure that every single one of you have access to the cash that you would need, and that all of your cash is protected, because there's simply no reason to take that risk, right? That this is, risking the protection of your cash to the solvency of a bank is just not one of those risks that you're rewarded at all for. So you should not be taking that risk. Okay, so so to the extent that we can just kind of wipe that risk away, I'm ready and wanting to have that conversation with all of you if it's necessary. But again, for the vast majority of you guys, you're all within the FDIC insurance limits. If those limits at 250 are even still relevant, there's lots of people who think that, with the stance the FDIC took, insuring all of those Silicon Valley Bank depositors who had more than 250, that it kind of sets a precedent. But we have learned from the financial crisis of 2008 and 2009 that the government does not always live up to its precedents. Specifically, it saved Bear Stearns, but let Lehman Brothers fail. And that's kind of one of those learning moments. So yeah, okay, that's the end of our prepared remarks. I will now take it off of focus mode, and anybody who has questions that they want to discuss, we're ready to answer those. But also, if you have questions specific to your situation, or changes you want to make, that's better addressed in an individual call with Dru or I after this Zoom meeting. But okay, let's go ahead.
Hello, John. This is Larry Beck here. Are you?
Hey, Larry.
You hear me?
Yes, I
How
do.
you doing?
Very good.
I have
Thank
a question.
Yeah.
Why did the Dodd-Frank Wall Street Reform Act fail? Apparently.
Yeah, that's a good question. Okay, so the Dodd-Frank Act was put in place after 2008. It created really rigid stress tests for any bank over $50 billion in assets. That regulation was then rolled back a few years ago, and essentially lifted the limit and made all but the biggest banks in the country not have to pass the same type of scrutiny. Why it was done was a political reason. Whether it would have made the difference in Silicon Valley Bank, who knows? But that is one of the actions that at least early on some legislators are talking about. But I think the more likely outcome of this is not that we see any new laws passed, because Congress generally doesn't like to pass laws, but we probably will see direction to regulators and grilling of regulators about why they didn't catch this. But that's actually a legit question, why they didn't catch this. I mean,
we weakened it. In other words, the politicians weakened it.
The politicians weakened they basically rolled back the Dodd-Frank Act, so that it only applied to the largest banks and not most of the banks in the country.
Thanks, John.
Yeah, no problem. Who else has questions?
Hey, John,
Yeah,
how are you?
very good. I can't even see your face though.
I
There
know,
you
it's because
are.
I got a window behind
Hey,
me.
hey, Tim, how are you?
I'm in cameo mode.
Awesome.
I'm in the witness protection
And
program.
that is what it looks like. It looks like the witness protection program.
Hey, did this Bitcoin and cryptocurrency did that have anything to do with the folding of the Silicon Valley Bank?
Um, Indirectly, yes. So Silicon Valley Bank
Was.
got hit with two things simultaneously. Okay, one was the value of their cash reserves dropped because of rising interest rates. Okay, now that alone wouldn't have tanked them. Okay, but the same thing, what happened simultaneously was that their customers started withdrawing large amounts of cash, not out of a panic, but because their funding had largely dried up. And so rather than these tech startups getting, millions of dollars from, VCs coming in and funding them and, helping them make payroll and paying their expenses, they had to start living off of their cash. Okay. And the collapse of Bitcoin was part of that, right? The collapse of the cryptocurrency markets were part of that. Part of that drain on the VC capital, okay, because it was one of these kind of shocks to these VC funders that caused them all to start pulling back a little bit, right? So that's why I say indirectly it led to it, because it was all part of the kind of the drying up of capital for these tech companies. Now the bigger concern and what would affect your portfolios is if we continue to see a trend of this drying up of capital for businesses and business owners. All right. If you're we're not talking about tech startups, right? If you're typical mom and pop kind of business owner, manufacturer, people making a living every day kind of thing, if they can no longer get access to capital, just like these tech companies could no longer get access to capital, that's when you start seeing the economy begin to spiral down. All right. The extreme example of that was the 2008 financial collapse, where all funding across the board just dried up. Okay. That's extremely unlikely to happen.
Okay. All right. Thanks.
Yeah, no problem. Yeah,
Hey,
Fran.
John, it's Greg.
John.
Let me have Fran go first.
Oh, sure,
Yeah.
sure.
Sorry, I
please.
didn't know I stepped on somebody. Okay. John, the FDIC limit of 250,000, is that per institution, per depositor, per account? What?
Good question. It's basically per ownership type. Okay. So it's per ownership type per institution. So let me explain. Okay. So if you have an individual savings account at Bank of America, that individual savings account is protected up to 250,000. If you then also have a joint account at Bank of America, that joint account is also protected up to 250,000. If you then have a joint account with your daughter as the payable on death, that's another 250,000, all at Bank of America. Now, then if you go across the street to Wells Fargo and do that exact structure over again, you've got 750,000 at B of A plus another 750,000 at Wells Fargo. So now you have 1.5 million of FDIC insurance altogether. So it's per ownership type, per institution, with an aggregate limit of like 2 million, I want to say, but I might be out of date on that.
Oh, okay. Thank you. That helps.
Okay. Greg.
Hey, John. Question for you. Is it possible that the Fed, being that they were so focused on essentially tackling inflation, they took their eye off the larger picture, being the financial, sort of well-being of banks and lenders and everything else that essentially is affected by higher interest rates?
I mean, that's a bit of an opinion question. You know, the Fed has three responsibilities, and sometimes these three responsibilities are in conflict. Okay, their first responsibility is to keep inflation to a target of 2%. Okay, their second responsibility is to keep a level of so-called full employment, which roughly equals an unemployment rate of about 4%. Okay, their third responsibility is to be the funding, you know, the lender of last resort to the financial institutions. Okay, so yeah, I guess it's hard to say that that certainly raising interest rates to tackle inflation is hurtful to these financial institutions, which have to own these bonds. Okay, now where the banks blew it, the ones that did blow it, where they blew it was they got greedy and they bought bonds that were too long of a term, too long of a duration for their depositors. Okay, what Silicon Valley Bank should have done and would have been responsible was to buy shorter term bonds that wouldn't have been so interest rate sensitive. So, you know, I mean, you can blame the Fed. There's plenty of responsibility to go around, but I think, you know, SVB's management and, you know, really blew it, and, you know, they're out of a job now, which is good. That's the way capitalism's supposed to work.
Gotcha. Thank you.
Yeah. Any other questions?
Yeah, John.
Yeah, Steve.
Yeah, John. Yeah, you're being too easy on these guys from Silicon Valley. Bunch of greedy scoundrels. You know, and I think Dru said it. I hope there is an investigation. You know, they're gambling on other people's money. I mean, just not right. And didn't the Lehman Brothers CEO say at one time before they went bankrupt that, oh, we got plenty of assets? Bunch of liars. Anyway, the question that I have is, I had a vent. Question that I have is on the TD Ameritrade. There's an insurance called SIPC. Are you familiar with that?
Yes. Good. Oh, I'm so glad you brought that up, Steve. Yeah, I am.
Can you explain what that is?
Yeah. Okay. SIPC. Okay. Some people make the mistake of thinking SIPC is similar to FDIC. It is not at all. Okay. SIPC coverage only protects you in the case of fraud. Okay. And SIP insurance steps in and makes you whole if you have been defrauded by an SEC or FINRA registered, you know, brokerage house. Okay. It is totally irrelevant to the conversation we're having today.
Okay.
Okay.
Okay, thanks. Yeah, that's good.
And
Yeah.
Can I
Yeah.
talk? Okay. And on Steve's comment, my wife Laura just told me, and this is hearsay at this point, but evidently the leadership over there at SVB, as usual bank procedures, is grab some parachutes on the way out with some of the money before it tanked, which to me, those guys ought to be strung up for this kind of stuff. You know, really, anyway, that's just my opinion. This is an opinion. But my question was more along Charles Schwab. I understand that we're only really concerned with money over 250K in cash or money market there. But other than that, with the fact that they are kind of holding our portfolios, what's our concern? You know, is this just, if they go down, this is just real hassle. We're not losing our investments, but it's going to be a problem for a while to get a new nest.
It'll be a hassle. You're absolutely right. It would be an inconvenience. It'll be a hassle. It'll be scary. It'll be a pain in the butt. It'll be all those things, which is why right now our top priority is monitoring that situation. Okay. Because frankly, if I were to find out tomorrow Charles Schwab was going to go bankrupt, Okay, there's not a whole lot I can do to move your investments in a single day, right? You know, I can't get accounts open at Fidelity and move everything over, right? And so, you know, it's kind of one of these situations where, you know, it's extremely unlikely to happen. It really is. It's extremely unlikely to happen. Okay, it's a little more likely today than it was a week ago, but it still falls into the category of extremely unlikely to happen. And so it doesn't make a whole lot of sense to like do something about it because it's still in the very improbable, you know, area. But what does make sense is to prepare for that possibility, to know what is the plan if that does happen. And that's the best thing we can be doing right now, which is really the purpose of this call today, right? And so, you know, if any of you guys do have, you know, deposits that would not be protected, right? You know, what is the plan? How can we either get those protected, or how can we make sure that you would have access to cash, you know, for a long enough time that if Schwab did go bankrupt and we couldn't get access to your money for a week or two, you know, what would be the plan in that case? Because what would happen is, let's say Schwab did go bankrupt, okay? You know, we already said all of your investments are segregated assets. They're not an asset of Schwab, so they're protected. They're there no matter what. What would happen is somebody would buy them. Okay, matter of fact, who bought Silicon Valley Bank for £1? Was it JP Morgan? UBS? Somebody bought them. Somebody bought them for £1. Because their parent company was actually a UK company. So anyway,
HSBC.
HSBC, thank you, Drew. Somebody would step in and buy Schwab for some amount of money, right? And they would now become the new custodian of your accounts, right? And so it would just be a matter of working out the technology of that. So it would be an inconvenience, it'd be a pain in the butt for a little while, but your money would be protected, and that's really the most important thing.
Okay, thanks.
Yeah. Other questions? Okay. All right, good. Well, as I said, if you have questions specific to your own situation, did you have a question, Ricky? Stan, I can't hear you, buddy.
They're on mute.
Stan, you're on mute. Okay. Well, if you do have questions specific to your own situation and you want to review it, please do schedule a meeting with either myself or Drew. It can be as quickly as a 15 or 20-minute conversation just to answer a few concerns, or we can really dive deep. Either way, I'm happy to make myself available to you and my whole team. Oh, Stan, did you figure it out? Did you have a question?
I just want to, what happens if the accounts are hacked? We'll say they hack 50,000 accounts. You know, how does that work?
If your accounts get hacked?
Yeah, I'm just saying, is that, what's the responsibility with that?
Yeah, that's where the SIPC protection comes in the case of fraud.
Okay, I get it.
That's an example of that.
Thank you for clarification.
Of course. All right, everybody. Thank you so much for attending. I will be blasting out a recording of this. So if you know of somebody that would benefit from hearing this conversation, please feel free to forward it on. Like I said, please also take advantage of scheduling a meeting with me or my team to go into any of these details. And then as this situation evolves, if things change, we won't hesitate to schedule another one of these. It's my job to keep you guys informed and up to date so that we're on top of it. And sometimes that means you don't need to worry. And sometimes that means, hey, we really do need to worry about this. But today, I'm kind of here to tell you, at least for right now, I don't think you need to be worrying. All right. Take care, everybody.
Okay,
Thanks, John.
Thank you, John.
Thank you, John.
Thank you, John.
Bye-bye.
John.
Thanks, John.
Thank you. My pleasure.
Thank you, John.
All righty. Thanks, everybody.
Bye.
Bye-bye.